Hey there, everyone. Today on the final bar, another choppy day for stocks. The S&P is slightly higher, stalling out again, right around 4,500. We'll talk about earnings. Some of the big box retailers reporting over the last 24 hours here through the remainder of this week. Walmart, Target, Macy's. We'll review those charts and more. Craig Johnson of Piper Sandler joining us from Minneapolis. Which stocks deserve your attention today? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical toolkit, I would argue, is designed to help you get out of your own way. As human beings, we are hardwired to make some pretty poor decisions because we have all these behavioral biases that tend to occur between our ears as we're trying to make better decisions. I would argue charting, technical analysis provides a practical set of tools to help you minimize the impact of those behavioral biases, help you focus on the evidence of the markets themselves, and help you better identify opportunities and better manage risk. Again, I was in Texas A&M in College Station, Texas last week. We had a great discussion with some fellow CMT presenters and a number of the students and faculty there. It was a great reminder of just the value of technical analysis for risk management, right? We always think of it as what's the next big thing, what's going to work, where do we want to be invested? I would argue one of the great benefits of charts is to just get you out of your own way, to recognize when the evidence changes, when there's a change of character, and when the price action tells you to start to do something different. Hopefully we can help you identify some of those inflection points through the natural course of our show, The Final Bar. We have a great guest today, by the way, Craig Johnson of Piper Sandler, bringing some long-term charts with us, also some actionable ideas that he is finding in his work with clients. Let's get to our market recap and see how things played out today. As I mentioned, kind of a choppy day. Before we get to the specifics on the major benchmarks, I did ask you in a poll recently, does the S&P 500 make a new all-time high before year-end 2023? Very straightforward question, with a difficult answer, I guess, right? It's hard to predict the future, and that's not the goal. It's more to stretch your thinking and think about what's the likelihood of the S&P making a new all-time high. That would get us above 4,800. All of a sudden, the 5,000 level becomes a level we would start talking about. 58% of you saying, yes, we make a new all-time high before the end of the year. Only 42% saying no. I tell you, before the last couple weeks, I would be a no 10 times out of 10 with that question. I would say in the last week or two, I've definitely switched where I think that is a very likely outcome. And, before you start thinking, all right, no, you're bearish, you're bullish, why are you switching? I would argue it is totally fine to switch your perspective when the evidence tells you to do so. And that is a key differentiator, right? It's one thing to just sort of guess, I think this is going to happen, I think this might happen, I think this might happen. At the end of the day, when the evidence changes, I think you need to change as well. And adapting market conditions is one of the most important things you need to do, I would argue, as a successful investor. So I'm seeing a lot to be interested in. I'm concerned by the strength and the sudden move in the rally. A lot of things overbought. Not surprised we're having a lot of choppiness this week after the big move higher on the CPI number earlier this week. At the end of the day, though, weight of the evidence, bullish at this point, I would argue. We'll see what today's guest says, by the way, but overall, a lot to be interested in. Now, a lot of earnings, and let's talk about the major benchmarks. We'll touch on a breadth indicator or two, and then we're going to get to some of the individual stocks, I think, in the news or on the move today. Now, sort of a nice move higher. You can see a little preview chart of the Dow with this sort of spike higher in the last hour of trading. Things were looking a little less ideal before the end of the day when you had this rotation higher. But again, still kind of a choppy, unchanged day more than anything. The Dow actually finishing just below 35K. And this is down slightly, about 0.1% from yesterday. The S&P and the Nasdaq, again, both about 1%, 0.1% that is higher. So really no real change. So after that big spike higher, we've now had a couple, what we call a digestion day, right? Or a digestion days. You have that big Thanksgiving dinner. Then you're sort of letting things digest. You're sort of sitting back. And I think the next thing that happens is still an open question. We'll see what additional upside we have for stocks. Earnings could be the catalyst to move things higher, but still an open question. Now today, while the major large cap benchmarks were sort of flat, mid caps and small caps both down. So the S&P 600 small cap index down 1.6%. So bit of a different feel than what we've seen recently. That big up day on Tuesday, small caps ripping to the upside, leading the S&P higher. Today, a little bit of a mean reversion to that move. You're seeing small and mid caps moving lower, while the large cap and mega cap stocks sort of holding their ground. The S&P 100 mega cap index up about 0.25%. The VIX just slightly different than yesterday. We're sort of holding steady just above that 14 price or level for the VIX. Looking at the fixed income markets, the yield curve generally moving lower today. So you have the 10-year yield finishing around 445, the 30-year yield around 462, and the 5-year yield around 443. So the yield curve sort of moving down. That means bond prices kind of moving higher. So the TLT, which is a Treasury bond ETF, up about 1.25%. The dollar ETF, UUP, essentially flat from yesterday's close. Looking at the commodity space, again, kind of a mixed bag. And I feel like I've said that most of the days when I've done the show this week, sort of mixed results from commodities. You have gold and silver higher. So the GLD, the SLV both up over 1%. The broad commodity ETF, the DBC that we track, was down over 2%. That's really because of energy prices that were so weak. Energy is the biggest weight in any sort of commodity ETF usually. So USO, the crude oil ETF, down almost 5%, certainly weighing on that. Natural gas prices down pretty significantly as well. That's hurting energy stocks, of course, which were the worst performer out of the 11 in today's trading. Now, it's so interesting. If you like volatility, you're loving the crypto space right now. It has been a choppy, noisy market. There have been times through the course of 2023 when it's been more of a low volatility environment. This is not one of those times. So big spike higher yesterday. Bitcoin actually getting up to 38,000 for the first time in quite a long while, rotating and giving all of those gains right back. So Bitcoin currently down about 5.25%. We're just below 36,000. Ether prices around 1950, and you can see all of the top 10 coins that we track in the red. We just recorded a really cool interview with Adrian Zadunchik. He's been a frequent guest on our show about once a quarter or so, I would say. Cryptocurrency expert, really thoughtful analysis about the crypto space now and seasonality in November and December going into next year, with the Bitcoin halving expected in the sort of winter to spring of next year. So make sure you tune into the Final Bar tomorrow. We will feature that interview with Adrian. Really well done, and some really thoughtful comments on the crypto space if you're interested. To finish off our market recap, let's look at the sectors here. Defensive at the top of the list. Utilities up about 0.6%. Technology and communication services, two of the FANG sectors, up about 0.5% each. On the downside, a number of the sectors down today. Energy down almost 2%. Consumer staples, consumer discretionary, both down 1 to 1.25%. Some of the earnings that we'll talk about here in a minute weighing on some of those consumer sectors. Kind of a consumer-oriented earnings week. Although some other things, some tech and others like Applied Materials, Intel types of names, but overall a lot of more retail focused in general. Let us get to the daily chart of the S&P 500, see how today's trading affected this chart a little bit. And again, what's interesting about a day like today, you see sort of this unchanged, sort of choppy environment that we've had. You look at the daily chart, we look at the weekly chart. Each one of those time periods tells a bit of a different story. And I would say the daily chart really shows you the strength that we've seen. And this is one of those times when I feel like every month is in some ways a very different story. And particularly the month of October to the month of November. Talk about a completely different environment, right? At the end of October, we're talking about undercutting the 200-day moving average. We're talking about undercutting the early October low. We're talking about the RSI becoming oversold again for multiple times during the month. We're talking about downside targets because it certainly seems prudent to think about where we might actually find a footing. All of a sudden, November starts and an acceleration to the upside. We've had a series of upside gaps, and gaps have come up in a number of our mailbag sessions here recently, and a lot of our Q&A. And in general, I think the basic idea with gaps is I tend to think of it as a little support level or a support and resistance range. So you could draw a shaded area or a series of trend lines on those levels. I think visually just keying in on some of those gaps, because market usually remembers where those gaps are. They often come into play, just like you did here at the September gap lower became resistance in October, and that's not that unusual. It actually happens quite frequently. So if we would rotate lower, I think you have a real obvious first initial level of potential support, which would be kind of in this 44.20 to 45.50 range. That would be this gap from just the last week or so. So if you do roll over, that's sort of your short-term tactical support. But again, the bigger picture, we're now sort of in this range between 4,600 resistance, the peak there in July. And then some of these support levels, the 200-day moving average at around 42.65, we'll call it, continuing to incline while we have prices up in this area. So kind of generally right around that 4,300 level. It might be a level of support as well, secondary support, as the S&P becomes overbought. But as I would remind you, something becoming overbought and oversold on its own is really just a short-term indicator, in my opinion. It's more of a tactical reading, right? Because it tells you that market's sort of over or underestimating the general point of where it should be. The bigger picture is looking at the range of the RSI, looking at divergences, looking for things that give you a sense of that broader time frame. And at this point, the fact that the RSI is even near the overbought range is usually more bullish than not. It tells you that buyers are coming in and pushing prices higher. So keep an eye on that gap if we do get a pullback going into next week, the holiday week with Thanksgiving. But overall, a lot to like there. I do want to talk briefly about breadth indicators, and we'll finish off our recap looking at some individual stocks in the news today. We highlighted this breadth indicator. This is the bullish percent index for the S&P 500. This looks at 500 point and figure charts and simply says what percent of them, how many of them are in a bullish signal most recently. And you can see it's currently almost up to 60%. We're just slightly below that. Now, we highlighted this chart back here when we got below the 30% level, and I've highlighted in green every time that indicator has gotten down to around 30% or gone below there. And then you can see when it's come out of there, it usually ends up being at least a very tradable bounce, often ends up being a pretty significant low like you saw in October of last year and in March of this year. So we had a couple signals here in early October, then late October, and just beginning of this month, we came out of that region suggesting upside. Now, the reason why I'm pointing that out, because there's another indicator that we would look at, running the bullish percent index on the Nasdaq 100. So these are, of course, mega cap growth stocks, generally speaking, sort of the technology, communication services, consumer discretionary trade, those names, the Magnificent Seven and other similar types of big growth names. The bullish percent index on the Nasdaq 100 has become overbought. It's gone above 70%. Now, this is not as an effective signal as it is on the bottoms, and this is what you can just see how often it's become, sort of overbought, quote unquote, by going above that level. But you'll notice when we do go above 70% and then come out of that region, that often means a bit of a drawdown. It could be a short-term drawdown like we've seen in some of these cases, but it's also identified some of those major turning points, some of those major peaks. So it just tells me that when we get up to that 70% range, sort of watch this chart and wait for it to break below. And that usually means we may be starting to turn lower a little bit. It just tells me to think a little bit more about keeping stops updated, managing potential downside risk. So note that this signal has quickly gone from 30% at the end of October to now over 70% in a very, very short window of time. Let's finish off looking at some individual names. A lot of big box retailers reporting this week. We'll start with Walmart, gapping lower 8% today. So not a great look. I mean, this stock up until today, probably just a great example of a leading name on an absolute basis for sure. On a relative basis, really hasn't made a ton of relative gains to the S&P, although the last couple months have certainly been stronger rather than weaker. It's been, for the most part, above two upward sloping moving averages and has remained above the 200-day moving average for the last 12 months. Today, gapping lower, and this is after making a new 52-week high yesterday. So that tells you how quickly earnings can change the configuration of a chart. So what do you do with this type of chart? So number one, I would say it's a good reminder, just be wary when a stock that you own or a stock that you're holding becomes overbought. That tells you we may be getting to that point where something will happen. We'll have a downside reversal. This one's a tough one to predict. I mean, this is sort of a binary outcome that was more negative. But look at where we're at relative to this area of support. What's encouraging about this chart for now is we've gapped lower, but we're right at the 200-day moving average. We're also right at the October lows. There's a pretty good area of support right around current levels. So we break below the 200-day. This chart all of a sudden looks a lot worse, I would argue. As long as we hold the 200-day, this is more of a pullback within an uptrend kind of look. And that's how I would think about these sorts of names. When there's a big gap, look to the left and see where we're at relative to some of those key levels. That's where you may want to think about some opportunities. Macy's, a similar idea in terms of a gap, but a very different direction. Macy's has actually been rallying this week. Today, strong open. It actually opened above 14, around 14 and a quarter. But look what happened through the course of the day today. We always talk about with gaps, or a lot of times the gap itself can be difficult to predict, right? It's hard to anticipate whether Macy's is going to gap higher or lower on any given day, even around earnings, right? That's a tough binary call to get right consistently. But we can observe what happens afterwards. So for example, look what happened here with the gap lower on Macy's, and then it traded lower through the course of the day. And then, of course, we just continue to follow through. So no willing buyers coming in around $13 a share back here in August. There's more and more selling pressure going down. Bottomed out just below 11. We're now rotating higher. Today, what concerns me, the gap higher is good. The fact that we traded lower through the course of the day suggests to me anecdotally, big gap higher. People are thrilled to cash out in Macy's just above 14. All of that selling pressure causes the price to go right back down. So I think a big question mark on the bullishness of today's gap, given the fact that we've traded lower through the course of the day. Compare that to what we saw with Target this week, right? So Target also gapped higher on earnings, closed higher through the course of the day. Today, another nice update. So you are actually getting some anecdotal evidence that in the short term, additional buyers are coming in. Now, this one has the opposite problem of Walmart, which is it's now facing resistance. Resistance here from June and July. Also the 200-day moving average. I think this is a much better chart if it gets above the 200-day, kind of holds that level for now. An interesting one to watch. The semiconductor ETF testing a monster resistance level. We've highlighted that recently here with charts like NVIDIA and others. Real question mark as to whether they'll be able to power through arguably a significant level of resistance. Some semiconductor stocks doing just fine. This is a chart of Intel, arguably in a lot of ways a bit of an outlier relative to some of the other semiconductor space. But look at the consistent positive relative strength that we've seen in Intel, really from the March low all the way to where we're at this week. Every month, you've seen a general incline in the relative strength with some brief pullbacks. But overall, this week, once again, resuming this uptrend, powering above the previous high around 40, making a new 52-week high this week, up almost 7% today. That's a nice run. Now we're overbought, which usually, again, the general thought I have when we're overbought in this sort of environment is you'd expect at some point at least a brief pullback, but the strength leading up to that overbought condition usually means there's further upside to be had down the road. In that same group, we have Applied Materials, and Applied Materials looks like some of the other semiconductors, kind of what the general chart of semiconductors feels like to me, which is a nice rally in November, but now trading up to key resistance. So with a chart like Applied Materials, another earnings name, we're very interested to see if we can gap above and then hold that level of resistance, which could become support here. So around 155, that was the high from early September around Labor Day. Also the resistance are where we ended up today. We're overbought right now, so we're bidding up pretty aggressively going into this earnings release. We'll see if there's enough upside momentum afterwards. But I think this level right here where we're at, a key one. If we do trade higher, I would keep an eye on that as potential support. Finally, two other retailers just to finish up. Gap down about 2.8%. That's not a price gap, but the actual company, the Gap Incorporated, reporting down 2.8% today. And then Ross Stores is another one. This is a name we've highlighted as this cup and handle pattern. Trading lower going into earnings today, down about 3% going into the close. We'll see what happens with the earnings release. Again, this rim of this cup is a pretty important one. We're right about there, but we need to see follow through above that level of resistance. That's our market recap for today. I'm going to bring on our guest today, Craig Johnson, in a moment. Before we do so, I want to remind you of a couple things. Number one, we'd love to hear from you. We will do a mailbag as soon as we can. We haven't been able to get to one this week. We'll hopefully get to one next week and feature some of your great questions that we've received. Best way to get questions to us, email thefinalbar@stockcharts.com. During a live show like this, just drop a comment in the live chat feature. We gather all those questions every day. If we don't get to them during the broadcast, we'll put them right in our mailbag. You can also put a comment below the video you're watching on our YouTube channel. On the Twitters, just tag us in a comment at FinalBarSCTV. And of course, we would love to hear your questions, feature them in one of our upcoming mailbag episodes. We have a Cyber Monday special coming up very quickly in preparation for this time of year, the Thanksgiving holiday and all of that. We have a Black Friday week sale, which is actually starting on November 20th. If you go to stockcharts.com/special, this is the best time of the year. I will promise you to re-up your Stock Charts membership, or if you've always thought about it and have never tried it, it's a really good time to do it. You basically can lock in a much lower price. You can get a bunch of additional months depending on what sort of time you lock into. And as a reminder, if you are a current paid subscriber, which of course you all should be, but if you have been a paid subscriber for a while, this is the best time to push your subscription out quite a bit, and you will get the special rate as well. So really good time to do it. Go to stockcharts.com/special. That'll go live here in just over 3 days. I want to welcome on today's guest, Craig Johnson. Craig's the Managing Director, Chief Technical Analyst at Piper Sandler, coming to us live from Minneapolis, Minnesota. Craig, how are you? Good to see you again.
about that, Dave. Thank you for having me on. I've been a member here for 16 years, and I will be locking in at the cyber special right away here in 3 days. So I'll be there.
Well done, and thank you, Craig. I appreciate it. No, it's good to see you, and as always, I really appreciate you taking some time to share some thoughts with us. A lot of uncertainty, a lot of confusion, a lot of question marks. All of a sudden, it feels like in the last week or two, it feels like some of those question marks can be scratched off a little bit. But I'm very curious. You've really, I think, been on the right side of things. You had a year-end target, which is not far from current levels. Start with your monthly chart of the S&P. What's your situation now? What do you think? What do you see?
Yeah, let's go through the the big picture of this whole thing. So you're right. We got a 48.25 objective. We started 2023 with a 46.25 objective, bumped it up in the July time frame when we got right up to that 46.25. And from our perspective, we think the weight of the evidence still suggests that more room to go. Keep in mind, from the long-term chart we brought out, we haven't had a secular change of trend. The trend has still been up. All we've done is come back and retest that. So from our perspective, 48.25 we think is an achievable goal, and then we'll reassess from there. Go on to the next chart if you could, Dave. Let's talk about why this market is doing what it's doing and where a lot of the confusion is coming in. The key thing is money is no longer free. And I think that's what everybody needs to remember. We've gone from basically a sub 1% 10-year bond yield to now a 10-year bond yield that is at 4 and change percent. And this sort of huge long-term secular reversal should not be ignored. There's only been 3 secular reversals throughout history. One was in the 1950s, the other was in the 1980s, and then the one we just saw last year. You've also had a 5-wave advance off of the lows, and you can see that there on the chart, Dave. And now what we need to do is come back and retest. The big guy behind me would always say you got to have higher highs and higher lows. We haven't even checked back to make that higher low yet. So look for 10-year bond yields to come down and then retest. And this is going to power equity markets higher over the next couple months. Go to the next chart if you would, and I'll just make the observation that you can see that we started to have an uptrend violation in the 10-year bond yields. And as that starts to play out, the next area of support we should be really thinking about would be around 433, somewhere in that kind of range Dave's highlighting. And then after that will be the 200-day moving average, which gets you down to a 3 handle on the 10-year. So again, a non-consensus viewpoint, but look how you're getting the confirmation with RSI there at the bottom. And you can see the divergence, how you made a lower RSI while the yield was still going higher. A good indication and something to pay attention to. For me, I want to sell something when I start breaking below the 70 RSI. I'm okay holding it while I'm above 70, and because that means you got good momentum and good strength in the trade, and then sell it on the way out. Next chart, if you would. So let's take also a look at what's happening between large cap and small caps. Large caps with the Magnificent Seven have been doing fantastic, but at this point in time, they've had such a large divergence when you look at the OEX versus the SML. I think you're at an important inflection point. Note the divergence in RSI. You can use that even on ratio charts like this. And from my perspective, I think there's going to be a pretty good catch-up coming with the small and mid-cap stocks. And that would be very beneficial also to the Russell 2000. Go on to the next, if you would. And then let's take a look at the KRE. The biggest 3 components of the Russell 2000 is going to be financials, it's going to be healthcare, and it's going to be industrials. And with the mini bank crisis that we had in March, financials really took a hit. But look at the higher low that you're now making from here and the reversal of the downtrend off of those February, March highs, and also the break back above the 200-day moving average. And more importantly, momentum is starting to go from negative to positive with RSI moving above the midpoint in here. So all things are lining up. And I would say these financials could be a real winner next year, especially if the Fed starts to cut and the yield curve normalizes in terms of the direction. Talk about some individual ideas too. Take a look at Zscaler. Certainly very meaningfully still off of the highs that you had back in 21. I don't think cybersecurity is going away anytime soon, but you've got your classic inverted head and shoulders bottom, and you just broke out above the neckline. So if you were to measure from the lows to the highs there, you're talking almost 80 points. So add that on top of it, and you're getting a really nice move back to where you were in early 22, which could get you Doing the math quickly gets you back up into that kind of low mid 250-ish range.
Mm-hmm.
And then next would be take a look at Shopify. Again, a lot of people are trying to save money. Shopify is a great place if you're looking to buy some home furnishing things. Certainly is cheaper than going to Ethan Allen. I let my wife know that on a regular basis. And you've got this sort of great sort of cup and handle here and sort of bullish breakout that has taken place. And it looks like we're starting another leg higher. Momentum is agreeing with us in here. And so we could probably go all the way back to the 21 March, April lows, Dave, is sort of a measured objective. Just draw that straight all the way across would be kind of a measured objective back toward the low 110s, which would be a great setup from here. And then also think about Costco. It's a little bit weak here today on the Walmart news, but again, people are making a strong choice. They probably are choosing not to go to Target. They're going to Walmart. They're going to Costco. And these stores have been faring pretty well. It's also a place to go if you're being a little bit more budget friendly at the household too. But even though it's pulled back, you still have positive momentum when you're looking at RSI at the bottom, and you're still above a 50 and a 200-day moving average.
This is fascinating charts, Greg, as always. I really appreciate going through all of those things. I'd love to go back to your chart of small caps versus large caps. Obviously, one of the big, I guess, caveats that we've had in 2023, the market at times looking quite strong. Small caps really not performing on a relative basis particularly well. We're once again back to that kind of mega cap dominance. Do you see further upside if just the mega caps are dominating like they have in 23? How important is it that you start to see small caps participating, which we really are seeing now in the last week or two?
David, just sort of breaking apart the index and thinking about what people use for small cap land, you got a lot of financials, you got a lot of healthcare, and you got a lot of industrials that fit into that mix down there. And if you start thinking about what's going to happen with interest rates coming up, that's going to be a significant driver and a significant catalyst. When you go back and you look at history from when the Fed is done with what ultimately does well at a sector level basis, financials usually do quite well from that perspective. So more of the interest sensitive parts of it. I think the mega cap 7 stocks, they're having another leg up. You're seeing Microsoft doing well. But what I would say ultimately, though, is at this point in time, if the mega cap 7 just goes sideways, okay, we can see a pretty good catch up for mid and small cap stocks. So if you're thinking about your absolute versus relative performance over the next several months, I think you're going to get better relative performance down cap versus up cap. And that's not to say that the mega cap 7 isn't going to do well. They are going to do well. But I got to tell you, there's a lot of retail folks out there that, all of a sudden they had a great year. But when they look at their holdings, they're going to realize that maybe 4 or 5 stocks represent 30 or 40% of their holdings. I wouldn't define that as prudent diversification at all.
Yeah, it's interesting when you look at the returns year to date. Obviously, areas of the market that have been struggling magnificently, right? Even though the mega cap stocks have done quite well, of course. I'd love to ask you a question. We didn't feature the chart of crude oil, but commodities have sort of rotated lower. Crude oil in particular has come off here recently. It's put pressure on the energy sector, which had been one of the stronger parts earlier this year. Now starting to rotate lower. How much does a weakness in oil play into your big picture thinking? And is there an opportunity in energy, or is this a wait and see time?
I think now is the time to take some profits in the energy space. If you just look at crude oil itself, you can see there's a left shoulder, a head, and a right shoulder that's pretty well defined on that chart. You can see it here, and you can also see it on the Brent chart too. But if you measure from the neckline to the head down, you will ultimately see that your measured objective will take you pretty much down to those June, July lows. And that's where oil prices are likely going in coming days. And then hence, you're going to see a lot of these energy stocks start to roll over. Our energy guy would tell us, Dave, that these E&P stocks will struggle between a $70 and a $65 oil price. And I think that's sort of what's in the making.
Certainly seems to be where we're headed here right now. Just to finish off, Greg, when we're looking at the S&P, you'd featured obviously this renewed strength. Can't deny it. And again, I've fought this here in October into November because it certainly felt like we were starting to break down. But the market has just reversed. There's a lot of speculation that I've heard that their short covering has been a part of this sort of rally in some small or large way. What would you need to see on the chart of the S&P 500 to sort of get a much more defensive feel? I guess the different way to ask it, what would the S&P chart need to look like for you to say, okay, this is not as strong as we thought. This is more of a weaker environment. Is it a particular level like a 4,300 or something, or is it more a signal you would see from the mega cap stocks? Like, what would tell you conditions are worsening? Otherwise, it seems pretty strong here.
Yeah, so I'm going to continue to keep watching the overall breadth in the proprietary work that we do here at Piper. I can see that we've got 40% of our groups remain above a 40-week moving average, Dave. That's been re-accelerating again. So that means it's broadening out and beginning to participate. I'll be watching that. I'll also be watching for any indication of a lower high getting made here on this particular chart. And I'll be watching RSI at the bottom to provide another sort of indication down there to see if that's rolling over. Right now, it's kind of like, hey, we're above a 50. We got back above our 50, 200-day moving average. We reversed the downtrend and recaptured the chart channel. It seems like we got a real good shot to go retest that gap right around that 45.50 level. And if we close that gap there, you're going to break above that 4,600 and have a good shot to a year end. And if you look at even a longer term chart, Dave, I'll be watching the upward trending channel that's been in place for the S&P 500. And as long as we sort of continue to play pinball inside of that channel, I think we'll be in good shape.
Well said. Craig, listen, this has been a pleasure as always. Thanks for bringing some charts, bringing some expertise with us. Stay warm and be well there in Minneapolis, and we'll talk to you again soon.
Thanks, Dave.
That's Craig Johnson. Craig's the Chief Market Technician at Piper Sandler, coming to us from Minneapolis. That is such a beautiful just run through of a macro perspective and getting down to some of the individual names. I hope you guys caught some of Craig's comments about interest rates, talking about that interest rate environment. Again, he mentioned something along, this is the chart to watch to sort of get a sense of what was really driving things, right? If you want to know what's driving things, look at the 10-year. Yields moving down a little bit from here could have some profound effects on equities, particularly growth stocks that can do much better if rates are not aggressively moving to the upside. Great take there, as always, by Craig Johnson at Piper Sandler. We've got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're going to start with semiconductors. I talked in our market recap about some of the semiconductor names, Intel, Applied Materials on the earnings list this week. And again, I think earnings are a very, sort of a fundamental phenomenon, right? This is the quarterly earnings report, but I would argue there's such a benefit to looking at the charts going into an earnings release, looking at what happens with a gap that would occur after an earnings release, whether it's bullish or bearish, looking at what happens during that day, right? Once the initial shock has worn off, are additional buyers or sellers taking action? And then what happens in the days after that, right? Do you see follow through? Do you see additional buyers or sellers coming in? What's interesting about the SMH, we just gapped higher earlier this week. We are trading higher so far and just getting above the July and August highs, right around 160, 161. We're kind of right there. I think a chart like this is really at that pivotal moment. Are we able to break out? And if a chart like this breaks out, I don't know how you can be anything but bullish on the broader market, because this tells you the foundation of the modern economy is doing fine, and that probably means our benchmarks are going to be doing well also. Overbought, though, so watch those semiconductor charts. Chart number 2, retail. I'm thinking of our friend Miss Schneider, a frequent guest on our show and friend of Stock Charts TV, talking about Granny Retail, the XRT. When I think about a conversation with Craig Johnson here about just the performance gap between the mega cap names having a remarkably strong year and sort of everything else, many names not having a particularly good year, the XRT is essentially flat for the year, right? If you look at where we started at the end of December of last year, if you look at where we're at right now, it's about the same. And that's the issue that I've seen with our equity markets right here. It's not like everything has been in a strong uptrend like we've seen in previous cycles. It's actually been a very different year depending on what area of the market you're looking at. I was a little bit encouraged when I see retail getting above the 200-day moving average for the first time since August. Today, moving right back to the downside, down another 3.5%. This is a retail-heavy earnings week, and I think by the end of this week, we may get some additional input as to whether retail has a potential to go higher. Not that the markets can go down or can't go up without retail being a part of it. That usually is a good indication of expectations about future consumer behavior. Finally, asked Craig about crude oil prices, and I love that comment. Certainly, you've seen distribution. This has been an area of the market that had been quite strong in the third quarter, rotating lower pretty aggressively here. This is the USO today, gapping below the 200-day moving average. We talked about this pattern, what you call a coil pattern, which is after a move, you have this consolidation of lower highs and lower lows. And I always remind people, this is a time to wait. to see if we break out to the upside or break down to the downside. Whenever we break, that usually indicates the direction of momentum going forward. Clearly, USO, crude oil prices breaking down and following through, and that's exactly what you'd expect with a coil pattern exiting that pattern to the downside. So weakness in crude oil means weakness for energy stocks, and that's certainly what we're seeing here in mid-November of 2023. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. No live show tomorrow, but we will be featuring our conversation with Adrian Zadunchik. Really good watch and a really good comments on the crypto space. Don't forget to like this video, subscribe to our channel while you're here. Special thank you to Craig Johnson of Piper Sandler joining us from Minneapolis. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.